This is Masters in Business with Barry Ritholtz on Bloomberg Radio.
On this week's podcast, what can I say? Savita Subramanian, formerly of Merrill Lynch. They got bought by Bank of America. She's been with them for 23 years. Her current title is Head of Equity and Quantitative Strategies. Savita is one of these women in the world of finance who is a powerhouse. Her quant work is wildly respected on the street. She's a regular on the Institutional Investor All-Star, I think, for like the past 11 years. She manages literally hundreds of models and helps create just an endless amount of research and content. Her work is super high quality and is relied on by a lot of institutional as well as Main Street investors. I found the conversation really fascinating. She is one of the few people who combine quantitative investing with behavioral finance. Not a common 1-2 punch, and she's fantastic at it. I found the conversation to be absolutely intriguing and a whole lot of fun, and I think you will also. With no further ado, my discussion with Bank of America's Savita Subramanian.
Thank you so much.
Subramanian. I think I'm getting your name. Subramanian.
I've heard all sorts of things.
I try not to butcher people's names, but let's talk a little bit about your background. So, BA in Mathematics and Philosophy from Berkeley, an MBA from Columbia. I'm kind of intrigued by the idea of philosophy and math. What was the career plan?
Yeah, well, there was no career plan, really. So at Berkeley, I ended up changing my major a few times.
From what?
Well, I started out as an electrical engineering computer science major.
Uh-huh.
And then I realized that there are basically no girls in any of those classes.
Well, back then, maybe not. More
not
today.
Now, yeah,
right.
Which is a huge relief. But I also realized that I love to write, I love to read, and I kind of wanted to have some sort of a liberal arts aspect in my career. I took a class called Existentialism in Film and Literature. It's like one of these Berkeley classes that,
right.
You know, this like completely pointless once you graduate, but it was
It's pointless when you're... I took an existential class in college.
Yeah.
I got a great mark on the midterm, and the final was a paper, which I never handed in, and the professor asked me why, and I said, what does it matter? And he's like, I feel compelled to give you a grade for
that.
An
A+, yeah.
I wish that was a joke, but it's actually true.
I wasn't that smart. I did all the work.
I read a quote from you way back when. You said your parents were pushing you to be either an engineer or a doctor. Is this true? I mean, it's such a cliche. Indian parents, Jewish parents, go to school, become a doctor.
Well, I mean, there's a reason it's a cliche. It's pretty much the norm. I mean, it happened to like me and everybody I know who's a child of an immigrant from India. So it's kind of, I mean, I think it was, it was the 70s. It was unclear how anybody was going to make their living. My parents were both in high tech. My dad was an engineer and my mom was a software person. So,
oh, really?
Yeah, they were both steeped in technology. We lived
in Silicon Valley?
In Silicon Valley. They were, early days in Mountain View before it was, Googleized.
Crowded,
yeah.
and just...
Exactly, before there was traffic. But it was, I think that my parents, they came here for us to have a better life, to make some money, to basically live the American dream. And I think that the only legitimate careers were really in the sciences or, kind of practical applications. Today, they've completely accepted me for who I am as the dark art of finance person. But back then,
you're the black sheep in the family
because
you didn't become a doctor.
In the family. Exactly.
Right.
No, my
see,
sister,
for Jewish parents, if you go to law school, they'll put up with that. It's like the old joke.
Law school is just barely acceptable.
Right. It's all right. We'll allow it. It's 3 years. We'll allow it.
Right.
But
right.
really, medical school is our first choice.
Exactly. Yes, you know the drill. So I was a rebel, and I mean the reason I did mathematics and philosophy was that I have a very short attention span. So I found myself getting kind of bored with my math problem sets, and then I could shift to philosophy and then go back and forth. So it was actually pretty ideal for me.
So how do you end up at Scudder Kemper in both New York and San Francisco in the 1990s? At that point, I know we'll talk about your internship a little later, but at that point, are you like, I think this is the career I want to be in?
No, I had no idea when I graduated what I wanted to do. In fact, I was convinced that I wanted to be a professor in philosophy. And I took the GRE and all those tests, and I applied, and I was going to get a PhD in philosophy, and I, did all the work. But I realized I had to support myself while I was waiting to hear back. So I got a job in finance. I moved to New York because I'd always wanted to be in New York. New York was my destination, and I got a job at Scudder doing something really random. I think I was working as a technical writer on their software application, but I was just kind of bouncing around and looking for, a place where I could earn a steady living and bide my time before I went to grad school. And then I started to realize that professors of philosophy end up having to live in really random places in the country, and
wherever they get a job.
They're, they don't make a lot of cash. And meanwhile, I was working at this financial services company, and I was really interested in what they were doing. It was kind of like philosophy meets mathematics, because finance to me is sort of a fuzzy science with no answers, very logical. So it's got this math angle where it's all numbers. But then there's this behavioral angle and psychological angle where, it's kind of a fun problem to tackle. So I realized I could make a lot more money working in finance than being a philosophy professor, and I basically kind of stayed the course.
Today's episode of Barry Confirming His Priors is brought to you by. So that very much is, one of the reasons I was looking forward to this conversation is how much everything you write is just right in my sweet spot. You could pull that out. But I want to talk about the internship, so let's go over there. So I mentioned you were an intern in college, and this is kind of fascinating. You interned for a Merrill Lynch Quant team, which fast forward 20 plus years later, that's now the team that you lead at Bank of America Merrill Lynch, now known as B of A.
Right, exactly. So that was actually my internship during business school. So after working at Scudder, I realized I didn't really have the foundations for financials. I didn't understand, kind of how to parse an income statement. And so I went to business school. I decided to go to business school, get that formal education. And then in the year in between year 1 and 2 of business school, I did my internship with Merrill Lynch, with a gentleman named Rich Bernstein, and yes, you know him.
I know Rich.
And that was the beginning of a wonderful career. But it's sort of strange. I don't know whether to feel proud or depressed about this, but I am the only person I know from business school. I graduated Columbia 2002, and I'm the only person I know who stayed in the same job for the last 23 years.
So you shouldn't be depressed about that. You should be grateful for, I found what I wanted to do out of school.
That's true.
And I've been honing that craft for 23 years. That's
the half full approach.
A lot of people, especially in finance, kind of flit from flower to flower until they find the right nectar that works for them. And it's kind of, look, it's not just me. I've seen a bunch of people. They start out as brokers. They eventually get a CFP, and they go to the advisory side.
Yeah.
Or people start out with a CFA, and they decide, I would rather manage the portfolio than I'd rather be a PM than advise the PM.
Right.
And so people kind of have to,
they
that journey.
Their path. Yeah.
You were fortunate that. So not only did Scudder lead you to business school, but business school led you to the job that you've had for the rest of your life.
To Rich, to Quant strategy, now equity. It's just been a dream come true. Yep.
So you had mentioned the behavioral side of finance.
Yeah.
Not a lot of quants marry behavioral finance to the mathematical side. Tell us how this sort of mixture, which I love. It works so well for me. I started on a trading desk. I kind of stumbled into behavioral finance in the mid-'90s before all the cool kids were doing it. And it suddenly all of this stuff that seemed sort of random, now at least there's an explanation for the randomness. And it kind of makes sense why people do the things they do. We're just not wired for this.
Right. No, I think that's the part of it that I find the most interesting is the idea that, a stock price doesn't really have the fair value of an investment instrument is somewhat arbitrary, right? And then it's supply demand, it's perception is reality for many of these companies. So I think the day that I realized that behavioral finance deserves a very prominent place in the arsenal of models that we all use was when I got the job as equity strategist, and I realized that probably the most important number that I publish is our year-end target. It's kind of a silly number, but people are going to think you're smart or dumb based on that number. And so I said, okay, let's use all these quant models that I've been building for the last 10 plus years. And after testing all of them, it turned out that there was one model that was better than everything else at predicting the next 12 months of S&P returns. And that was a behavioral model.
Really? How do you measure behavior in a quantitative model for equities?
It's a very cool model, and I actually was lucky enough to inherit it from my former boss, Rich, who I think inherited it from his former boss. So it's been around at Merrill for, since the 80s.
Who was Rich's former boss?
I can't remember. We'll have to get him on and ask him.
All right. I've had him on. Yeah, and I'm sure he's told me, but
he may. Yeah, we'll look it up in the annals. But it's been around it predates Rich Bernstein. So basically, this model is just a simple straight average of all the Wall Street strategists' recommended allocations to stocks in a balanced portfolio. So if you go to your broker and he or she tells you you should put, 60% in stocks or you should put 40% in stocks, we take all those numbers from the different houses and we average them together. We've been doing this every month since 1980. And it turns out to be the best contrary indicator on what
really?
You should do with
I thought you were
money.
going to go with, it's a very wisdom of crowds and the averages. Whatever it averages out, run the opposite
Do the
direction.
opposite, yes.
No kidding.
That was the punchline of this indicator. And I thought that was so fascinating. But then when you peel back the onion, you realize there's a reason for it. It's because, when everybody's looking at all this data and it all seems terrible, chances are that information's priced into the market and it's going to surprise in the opposite direction.
I want to say, to go back to Rich Bernstein's boss, was it Bob Farrell or was Bob Farrell two bosses before?
Gosh, I don't even
kind of remember him as late 80s, early 90s.
Yeah, Bob Farrell was, I never
70s,
met him.
80s, way before my time.
Did you ever have,
I met
Neither
him at a Market Technicians Association event. I interviewed him for one of their events, but Bob Farrell's 10 investing rules.
Yes, legendary.
That was gospel.
Yes.
And to this day is still,
yes.
You're hard-pressed to find another 10 rules that are as insightful and astute and still relevant.
Completely.
He's always been spectacular.
Yeah, he was onto something, and he created this framework. I don't recall, but I still have financial advisors sending me these Bob Farrell quotes, and I'm like, bring it. This is great. He was a legend.
Right. I want to say that might have been one of his quotes. I could quickly find it, which was something like, if everybody's talking about it, it's already reflected in the price. There's no surprise there.
Exactly.
When all the experts and forecasts agree, something else is going to happen.
That's right.
Rule number 9 from Bob Farrell. So you're definitely channeling a little Farrell.
Yep.
So given this, how do you draw a price target or a market forecast from, here's the average of all the Wall Street strategists. Let's say it's plus 8%.
Yeah.
What do you do with that? On average, aren't we about plus 8, 9% on the S&P?
So here's the thing. I mean, if you think about just how much this number changes over time. So it's been, back in 2001, strategists were telling you to put about 70% of your money in stocks. But then, just in, I think it was 2012, coming out of the financial crisis, after one round of QE, Europe was in a recession. Everybody was depressed.
Brexit, it was all happening.
Everything was all happening. The U.S. just got downgraded, and that was when that indicator plummeted to 43%.
Wow.
Which was exactly the right time you wanted to buy equities. And you
I remember
minted money since then.
2010, 2011, 2012. There was so much skepticism about equity markets. And my pushback to people was always, show me another time when down 57% wasn't a spectacular entry into U.S. equities.
Right.
And the answer is always 29 and 32. Okay. Is this like 32? Is this remotely like 29?
Right.
I mean, you already had the dot-com implosion. If you want to say that down 81% was your 29, fine. But that was, 7-8 years ago, and here we are down 57%.
Here we are again. I know. It was an interesting time. And that's right when I got the job as strategist. So it was really interesting because I was looking at this model, which was my holy grail, right? Out of everything we'd back tested, this had the best predictive power over the next 12 months, highest R squared. And it was telling us to back up the truck on equities. It was as low as it had ever been since the 1980s.
Wow.
And I remember, thinking, oh my gosh, is this a data error? And I quadruple checked the data. But it was, really a prescient signal that a lot of bad news was really priced into the market, and it was more likely to move higher. And, since then, it hasn't dropped to 43%, but it's been pretty low. I mean, I think we've been in this market environment since the GFC, global financial crisis, where folks have just been worried. And the most recent event that we anchor our memories to is this horrible credit crisis that derailed the banking sector, that crushed the consumer, and now we're just assuming that's going to repeat over and over again.
That's
forever.
the post GFC PTSD.
Exactly.
What was your experience during the first quarter of 2020 during the pandemic? S&P down 34%, neatly within the quarter. I noticed some people kind of panicked, and here it comes. And other people were like, no, down 34%, I'm a buyer.
But yeah, I think that it was one of those moments where I think I went on TV at some point and they said, do you buy here or is there more to go? And
yes and yes.
I said, you buy here. You pick your stocks, but you buy here. There are going to be a lot of really high quality companies that have been crushed by fear and loathing and, just heading for the hills. And this is an opportunity that we're probably going to look back on and want to buy. Wish we'd bought these companies.
Unfortunately, sometimes people in media or elsewhere, they talk about catching the bottom. And rather than being the bottom tick, you could look at that big sweeping parabola and say, I don't need to be at the bottom.
Right.
I just want to buy as we're getting close and buy as we're moving away from it.
Right.
And so that 2 years from now, my average cost is just far below where the markets are.
Exactly.
You don't have to nail the bottom.
No, and you never will nail the bottom.
Someone is going to get lucky. Someone's going to get that bottom tick, but 99% of people are not.
Right.
So rather than try and pick that, hey, down X percent, at down 25%, I'm a buyer. At down 30%, I'm a buyer. And I have enough dry powder that I can keep buying down 40%, down 50%.
Completely.
At a certain point, when everybody's terrified, it's a spectacular.
It is. It's a spectacular buying opportunity. I mean, there's one thing that I've looked at that seems to be a good leading indicator of, when you want to start stepping in, which is, momentum, right? There's a reason that there are so many momentum investors, because the market usually figures out whether things are kind of getting worse or getting better. And one of the models that we've used to determine whether something is actually cheap and attractive or cheap and a falling knife is looking at earnings revisions coupled with price momentum. And what we found is that when stocks are going lower, but analysts haven't taken down their earnings, so it looks cheap, but it's only because the sell side is late to react.
Right.
That's when you don't want to buy it.
You want to. So if there's downside momentum and you've had a whole bunch of, hey, we're changing our earnings estimate, we're changing our price targets.
Right.
That means it should be mostly priced in.
Exactly. So you want to buy a value stock when its price decline is starting to slow down, but estimate revisions are still deeply negative. So you're in this environment where everybody hates risk and they're downgrading, but the market's telling you, okay, things are actually not as bad.
Really interesting. So let's talk a little bit about a day in the life of a big bank's chief quant. Tell us, how do you spend your time? What are you doing during the day? And what do you... what keeps you curious? What keeps you wondering about what comes next?
Yeah, so my day is never the same, and I'm sure it's like this for you. I mean, most people have kind of things thrown at them that are, out of the ordinary, and I can't say that, I walk into the office and I sit down at my desk and I start chugging away at the computer, even though that's what I secretly want to do.
That's what work from home is for.
Yes,
Stay at home, keep your face in the computer, you're good. Once you get into the office, that's done.
Game over.
Right.
But but I think that where I get my best ideas is from talking to super smart people like you, like our financial advisors, like our hedge fund clients, our long-only investor clients, pensions. So everyone out there who's been a professional investor for a while has some edge that is, otherwise they would have been fired or left the industry. But I found that people's edges are different from one another. So I feel like every time I talk to somebody new, there's an angle that I haven't thought about. And then what I like to do is try to recreate that framework in a model, a replicable model, and then test it to see whether it's something worth throwing into the mix or not. And, a lot of my work is just looking at, does this, this indicator, like a PE ratio, right? We all talk about PE ratios and how you want to buy low PE stocks and, sell expensive stocks. But it turns out the PE ratios sometimes predict performance and sometimes they don't.
It's kind of worthless if you can't tell, is this a good moment to rely on PE or is this a bad moment to rely on it?
Yes. Is this a good value stock or is it a value trap? So those are some of the things that we test. And then, from talking to clients, we get ideas around, should you have a regime indicator? Should you think about what regime the market is in to train your framework on what types of attributes to look for? What attributes right now are scarce versus abundant, and where will investors pay up for a scarcity in the current environment? So, a lot of these are really born from behavioral finance and thinking about how people, look for opportunities, whether they're going to be a bargain hunter or whether they're going to be risk averse and look for unassailable growth. But it's interesting because I think that my best ideas to this day have come from talking to our really smart clients out there in the field.
So you guys run literally dozens of quant models.
Hundreds, yeah.
I get your research. I get a handful of research from specific people at I still think of it as Merrill Lynch, but
me too.
but I notice. So we'll talk about the content you guys put out, which is enormous, and we'll talk about the models. Let's start with the models since you mentioned it. So you talked about the consensus of strategists and how that is often, I'm assuming not always, but frequently a contrary indicator.
Yes, it's often, really it works the best at extremes. So if you're in some kind of neutral territory, it's not as informative. But if
True for all sentiment measures,
for
right?
any sentiment measure, exactly. So there are times when you really, really, really want to pay attention to it, and then there are other times where it gives you a little bit more of a muddled signal.
So that one stands out as prescient. What else do you think adds a whole lot of value and helps you navigate what's going on? What are the models?
So I think when you look at, one of the things that we've started looking at is just like kind of non-financial data. So, not fundamental data. Like,
and you're making a face as you say that, so
Yeah.
I could tell you're like, is the jury still out on that, or how are you playing with non-financial data?
Look, I think that some of it is really useful. A lot of it is just garbage.
Right. When you say garbage, is it not accurately depicting that subsector of the world, or is it just a noisy series with not a lot of signal in it?
A lot of it is just noise or corporate management trying to game the system. And I'll give you an example. So let's talk about earnings surprise, right?
Okay.
Earnings surprise is something that should work, right? If a company beats everybody's expectations on earnings, it should drive monstrous performance, especially if it's a big beat. But what we've all realized over the last, 20 years since Reg FD in 2001 is that management games their numbers and then they beat these made up numbers systematically. And that surprise factor no longer seems to be as effective as before we had this sort of massaging of consensus estimates.
The day before we recorded this, you put out a research report. Strong quarter, earnings per share up 6% year over year, with better guidance, and here's the really amazing part, with 83% of the S&P 500 reporting earnings, sales are roughly in line, and the stats were 72% of these companies beat on earnings. So if 3 quarters are beating on earnings, what's the value of an earnings beat?
Who cares?
Right.
Exactly. Maybe we pay attention to misses because those guys really screwed up and couldn't beat their made-up numbers. I think that there are different factors that tend to, at some point work, and then everybody figures out that they work, and then they start getting gamed. Quants have basically made markets that much more efficient or maybe inefficient. I'm not sure what the right way to look at this is.
No, I agree with you. I think quants have made, generally speaking, big money relying on data that's consistent.
Yeah.
What starts to happen is the inefficiencies get arbitraged out.
Right. The
and they go
short-term
away.
inefficiencies go away.
So
Yes.
some people have blamed quants on why value has underperformed, why small caps aren't doing what the small cap factor is supposed to be. I don't
buy into that.
I'm right. I think the jury is still out on that accusation.
Yeah.
That said, there are a lot of models out there that aren't particularly great. Let me ask you, what quant models do people seem to really be enamored with that you think aren't really worth it? You mentioned PE and fair value. Those aren't particularly useful to investors.
Snapshot multiples are not useful.
Right.
I think price to normalized earnings is useful. But, the other data set that I just wonder about is flows.
Because they're always on such a giant lag.
Yeah.
Like there were outflows throughout 23 from mutual funds.
Right.
And if you're saying, well, I guess if you're going the other way, if you're saying it's a sentiment indicator, but that's not how people talk. People talk about, we have all these giant inflows into markets.
Right.
Okay.
Who cares? That was yesterday, right? Why does that tell us anything about the future?
You got me. Give me another model you think is overrated that people rely on.
So I think another model that's overrated is just pure momentum. Because I think momentum works
until it stops.
Yes, exactly. So it's when it works well when it's accompanied by a fundamental reason. But the idea that you can predict price using price, to me, just seems to flaunt some kind of basic financial understanding.
Isn't that the entire undergirding of trend following?
Yeah. So trend following, I worry because I think we've been in a market where trend following has worked remarkably well for at least, a decade.
Certainly for commodities and for currencies.
Yeah, exactly.
Right? Maybe less so for equities or fixed income.
I mean, even in equities, one of the best performing quantitative factors has been momentum for a really, really, really long time. And one of the worst performing factors has been valuation. So we're now in an environment where all the 45-year-old portfolio managers out there have worked their entire careers in these momentum-fueled markets, and they've been trained to believe that valuation doesn't matter. And I think that's wrong, because valuation does matter. It matters over a longer time period than maybe just the next day or two.
Valuation matters eventually.
It matters. And in fact, one of the most powerful market timing models, not over the next year, but over the next 10 years, is looking at just a price to normalized earnings ratio for the S&P 500. That has explained 80% of 10-year returns. That's a super high R-squared.
How do you think of CAPE?
Yeah, so this is a cyclically adjusted PE ratio. And I think that that's exactly what you want to pay attention to when you're thinking about the long term. Unfortunately, nobody has the luxury of picking stocks for a 10-year period anymore, except for in our personal accounts. But professional money managers have basically been trained to believe that price predicts price. And that has worked for a really long time. But I feel like there aren't any value investors left out there. Do you ever worry about that?
So I have a vivid recollection of reading Adam Smith's The Money Game and not really understanding the discussion he had when I first read this, 30 years ago, that there's a fund manager, and all this fund manager does is hire young 20-something fund managers, and he describes it as they're smart enough and not battle-scarred enough to buy the stuff that terrifies me. And so I will ride these managers until they blow up, and then I'll fire them and replace them with the next. Like, it's a chapter in The Money Game. And when I was younger, I didn't get it. But exactly what you said about if you're 45,
yes,
and up until last year, the current generation of bond managers never seen a rising rate environment.
Gosh, exactly.
So what ends up happening is you have to bring in these young people who don't come with the baggage and the memory.
Yes.
So they'll do things that you're terrified of, and then eventually the conveyor belt replaces them. But I didn't understand that when I first read it, 25 years ago. Now I kind of get it for exactly the reason you described.
That's brilliant. Yeah. That makes sense.
And that book is just absolutely a Wall Street classic. For sure.
And maybe that means that we should only have the tails of the distribution, like the really old investors and the really young investors.
Take out. So it's a barbell.
Take
out everybody.
Middle-aged investor.
You and I, we're out. They got to be older than me or younger than you, and that's the range. So thank you for getting us
so we're out of
losing
jobs.
a job, right?
Yes.
But there is something to be said. So sometimes that works out, and sometimes that is disastrous.
Yes.
So on Twitter, I've been having this ongoing DM conversation with the guy, he's still anonymous, behind Tik Tok Investors. And what he does is he goes to TikTok and he finds the most absurd, ridiculous investment or money advice on TikTok, and it's that exact thing. It's 20-something with no experience.
Right.
The one he sent me this morning is this guy who's 20-something, and he says, so I figured out how I never have to pay taxes again. I make all my money in Bitcoin. I got a Bitcoin credit card. I go to the supermarket. I do this. I do that. It's all tax-free. Like, who's going to tell me I can't do that? And then the voiceover is the IRS.
Yes.
They track all of this.
You just told everybody
right?
What
you're going to
doing.
get a 1099 from wherever your Bitcoin exchange is. That goes to the IRS. What do you think? They woke up yesterday? I mean, come on. So the problem with people who don't have the battle scars.
Yes.
The problem with those of us with battle scars are sometimes we're a little risk averse.
Right.
The problem with people with no battle scars are they have no sense of, hey, there's a whole lot of risk in here in not paying your taxes.
Right.
Or in day trading from home or whatever, some of the
meme stocks and whatnot. Yeah, no, you're right. So you need that sort of institutional knowledge, that domain knowledge from the super old investor.
Right.
And then you need this like whole cadre of young investors that are kind of moronic but also are willing to step in and take a lot of risk.
So what you're saying, it takes all kinds to make a market.
It takes all kinds.
So when I started out on the desk, one of my favorite, my head trader had all these great lines that I should have written down. I only remember some of them, but I used to ask a question: why is this person saying this? This is so obviously wrong and money losing. And he's like, hey, someone's got to be on the other side of the trade. Otherwise, who are you going to buy from?
Right.
I guess that's true. It takes
two
sides to make a market.
That's the fascinating thing about markets, isn't it? There's always somebody that's willing to sell at a certain price, and there's somebody that's willing to buy.
So speaking of selling, let's talk about something that dates back decades. The sell-side indicator. I remember it in the early days. It was the Merrill Lynch sell-side indicator. Now it's the Bank of America. So what is the sell-side indicator? How does it work?
This is the model I was telling you about.
The consensus.
Using Wall Street to do the opposite and make lots of money. Mm-hmm. That's exactly what it is.
And you had nothing to do with its creation. You inherited it.
I inherited it.
Have you tweaked it at all since you've had it?
I've looked at it to see whether, it makes sense to use different leads or lags, whether there's information content in the actual distribution of strategists' numbers. But I think it's just it's a simple tool that just works because of the fact that, what we were talking about, just the fact that sentiment, when everybody thinks one thing, the market's going to do the opposite of whatever they're expecting.
Has the change in institutional sales and trading and just the way the sell side has morphed over the past few decades, a lot of the sell side has moved to the buy side.
Yeah.
A lot of big funds have their own analysts now that they used to rely on the street for.
Right.
Does that change this at all?
No, it's interesting. This is one model that has still kind of retained its efficacy. In fact, it's become more effective since the global financial crisis. If you just look at its track record of predicting positive or negative returns. So it's kind of interesting to see that just this old kind of hoary chestnut of a model still works exactly the same way it always did in kind of sussing out groupthink, herding, and basically doing the opposite. So that's why it's one of my favorites.
So you guys have a huge institutional and sort of mom and pop Main Street client base. Mm-hmm. What sort of analyses do you do with your own data?
Yeah.
You mentioned flows kind of are so laggy. Is there anything you see, especially on the behavioral side, from like Herb Greenberg used to talk about his email hate meter? Like if he said something and he got like a ton of hate, he's like,
I'm going to be right.
Yeah, I'm on to something here if everybody hates this.
I use that as an informal gauge of, what if we're getting a lot of pushback on a call, I feel, stressed out because everybody's yelling at me, but I also feel better about our call. But look, I think there are lots of tools you can use. So one tool that I really like is looking at positioning of the buy side, because what we found is, especially today, there's a lot of groupthink, there's a lot of career risk driving investment decisions.
When you say especially today, hasn't that always been true?
I don't know. I mean, one of the things that I've been looking at is just active share of the average active fund, and it's gotten the average active fund has gotten closer and closer to the benchmark over the last 5 years.
Bill Miller says active management is being destroyed by closet indexers.
Yes.
And that's the guy who beat the S&P 500 15 years in a row, up until the financial crisis.
Yeah, and I think that is empirically that's borne out by what we're seeing in our data. But what's really interesting is if you have a list of companies. One of the things we do every month, and it's just a laborious, horrible process. I used to do it, and now I'm fortunate to have one of my teammates do it. But you just basically scrape all the 13 Fs out there. You come up with what everybody loves and what everybody hates. And it's kind of like the sell-side indicator. If you've got a stock that is massively overweight, everybody owns it in the professional community, there's probably not that much upside.
Who's left to buy?
Exactly. So I think that positioning data is important. I love looking at like a new tool that we've been using more is kind of natural language processing applied to research or transcripts or, I'll give you one example. So we came up with this analyst tone metric.
Tone,
Tone. So we look at our own research and we track whether analysts within a sector are getting more positive or negative by virtue of just their language, not their ratings or their price.
You're counting how many great quarter guys or
essentially we're using these like these lexicon models to suss out how increasingly positive or negative analysts are getting on certain companies, certain sectors, certain themes. And it turns out to be a very good leading indicator for analysts changing their ratings, for stock performance, for earnings revisions. So there is something to be said for NLP or, kind of these more big data tools that are actually tracking broader signals over a long period of time.
So that's a very specific application of AI to research.
Yeah.
How do you see AI coming into your space, into the quant or behavioral space? Everybody says it's going to have a giant impact.
Yeah.
When do you see that happening, if not already?
I mean, I think it's already happened. If you think about just like certain industries have just gone away, right? You can... look, I think it's going to replace some of us. It's going to replace a lot of these processes that we do that are really, really boring and laborious.
That's scraping,
like
as
the
a perfect
scraping of the
example.
13Fs. But I think at some level you still need to have that domain knowledge and that level of expertise that trains the models. Essentially, I think that we could just create a pocket analyst at this point. You could create an analyst that, basically puts together the rough limbs of an earnings report, a report on earnings or a report on, a specific event. And then you have the analyst himself or herself read it and make sure it makes sense and, tweak it, et cetera. But there's a lot of that rote activity that can be replaced by AI. Whether AI can invest better than a human being, I doubt it because, I think that at some level you need that domain experience, you need that behavioral angle. You need to analyze what's different this time because there always is something different this time. I think that that's the other thing I've learned in finance is that you can never just apply the last crises playbook to the current environment. And that's something that I think it's hard to train a bot or a process on how to actually sort of determine what you need to factor in this time that is different from all of the historical data.
Right. They may not repeat, but they rhyme is the old joke, and very, very true.
Yeah, exactly. But there's always something that nobody's paying attention to that's going to blow everything up. And that's what, we need the human beings to fly around and look into the whites of the eyes of company management and, kind of figure out what's really going on behind the data. And I think it's like there's an example of this. If you think about, even that NLP process that I talked about where you're looking for positive and negative sentiment. So one of the things that happened over the last, 10 years is that management realized that quants are scraping their transcripts on conference calls for positive and negative words. And then there was a way to game it. You could just inject more positive words or, take out all the negative words. You could basically edit your script so that it would look like, you were saying all the right things for a quant model. So those are the types of things that I think, AI is never going to figure out, when that's already in the market, when folks are gaming the system versus when it's an actual accurate signal.
That's incredible. So let's talk a little bit about some things that are going on. I saw a quote of yours that I really liked. The idea that the market is too expensive should be debunked. Explain why.
Yeah, so I think that there is this tendency of quants, myself included, to look at a time series and say, okay, if the PE of the S&P 500 right now is 21 times, and it has mostly been below 15 times, and whenever it's been 21 times in the past, it's gone down. Those types of analyses, I think, are just deeply flawed, especially in light of the fact that the market itself is not one kind of monolith that's always the same. It's a changing animal. And if you look at the S&P today, 50% of it is asset-light, innovation-oriented healthcare and tech, whereas in 1980, 70% of it was manufacturing, asset-intensive, et cetera.
So let me ask you a question about that asset-light side. Some people, Michael Mauboussin is one, have made the argument that intangibles, intellectual property, patents, algorithms, et cetera, are deserving of a higher multiple, that they don't require a massive investment in factories, and they're not capital intensive.
Right.
They're not manpower intensive. They don't need a ton of labor. Shouldn't they be awarded a higher multiple than, a steel factory?
Right. So that's the idea, is that the margins are more stable. They're less reliant on risky labor, which, people can go on strike or sue companies, whereas processes can't. So I think there's validity to that point. I mean, when I look at the S&P today, it's not only is it a different animal in terms of its sector mix, but it's also less levered. Everybody took advantage of super low interest rates to term out their debt, and, so fixed rate obligations are de rigueur for the average S&P company versus floating rate obligations a few years, prior to the crisis. I think that also when you look at the labor intensity of the S&P 500, it's become much more labor light. And by the way, AI is going to give us the opportunity over the next 10 years to become even more labor light. I think the whole bull case around AI right now is not buying the chip makers. It's buying the index, because the index is about to become that much higher quality.
Let me see if I understand that, because it's really fascinating. Everybody's so focused with NVIDIA, and now Intel has caught a bid, and a few other chip makers. But really what you're saying is, look at who has a giant or outsized set of labor costs. Either they're going to be able to reduce their headcount, or their existing headcount is going to become so much more productive working with AI that we're not recognizing.
Nobody's ascribing that premium to all the clunky services companies out there. This is why I'm bullish on large cap banks. One of the reasons is,
which are cheap now, relatively speaking,
which are still in that value cohort, and they are also one of the few sectors that's become more labor intensive since the financial crisis. Mm-hmm. Why? Because these regulated banks had to hire all these legal and compliance and expert folks to make sure we weren't doing anything bad, right? So today, think about all those processes. Those are much easier to replace with an automated AI, bot, whatever you want to call it, than any period of time in the past. Generative AI is new. It's a new thing. It's a game changer for many industries. Call centers have gone away. I mean, entire industries have gone away overnight because of the advent of generative AI. And that's where I think it's really bullish, is in the ability to replace a lot of these rote, activities that people right now are being paid to do. So one of the things that I've seen in my quant work is that if you look at any sector of the market and any peer group, and you look at the labor-intensive companies and the companies that are labor-light, the companies that are labor-light almost always outperform their labor-intensive peers. So we are sitting right now at a point in time where over the next 5 to 10 years, or I don't know how long it takes, the S&P 500 has this opportunity and this new tool to become even labor lighter than it is today. That is hugely bullish.
Really, really interesting. So this leads me to what you've said not too long ago. There's a lot more to the S&P 500 than the semis and the mega cap tech. Is AI what's driving? Hey, you got to look past NVIDIA and past the Magnificent Seven to who are going to be the beneficiaries of all this new technology?
Yeah, I think that's right. I think it's not just new economy chip purveyors, but it's also the companies that buy the chips and become better. But I also think there's something going on right now that we should be really excited about, which is that interest rates are no longer at 0. They're at 5%. So the Fed has done a lot of work for us. Companies are behaving much more rationally today than they have in the past. They're thinking about how to become more efficient. This is something they haven't thought about for a really long time, because they had all these easy ways to make money. If I'm a CFO and I'm not going to make my earnings numbers next quarter, I could have borrowed cash for free and bought back enough shares to beat that number.
Right.
So there were lots of low quality ways of making money since the global financial crisis.
Not anymore.
But now we're back to a more normal hurdle rate. 5% interest rates is not super high. I think it's manageable.
Right.
And companies are making all the right moves. If you look at even these growth companies like Meta or Alphabet are now initiating dividends. They realize that part of their mantra needs to be cash return and capital discipline as well as growth. So, I think that we're at a point where the reasons to be optimistic on stocks are that much more than when we were at 0 interest rates pre-pandemic. I mean, think about it. The market has absorbed so much bad news over the last few years.
You not too long ago, someone asked you about markets climb a wall of worry. Like it's a bad thing. And
yeah.
Like, isn't that a good thing? Isn't that people are stressed out about things that the market's already sussed out?
Right, exactly. I think that's right. And I think, even when you think about where we were in 2021, at the end of 2021, I felt really nervous about stocks because for the first time, we were forecasting negative real rates, which is really, kind of a
problematic, to say the least.
It's irrational. Negative real rates, that's an irrational environment.
Let me borrow some money from you, and I need a quarterly check from you.
Exactly. I mean, it doesn't make any sense. We were forecasting something that didn't make any sense. Every economist out there was forecasting negative real rates. And that just felt like something had gone wrong. Nobody was expecting 2 wars to break out. Nobody was expecting the Fed to hike interest rates from 0 to 5 in a very short period of time. By the end of 2021, our sell-side indicator was at the most bullish levels we'd seen since the global financial crisis. Yep, nobody thought anything was going to go wrong. And then whammo, you saw a bear market. So today...
And by the way, a bear market in both stocks and bonds.
And bonds,
which is something that you don't see every 40 years was the last time we saw that.
Exactly.
So there the sell-side indicator really worked exactly as planned. So let's talk about where we are in the current cycle. I know you like to discuss there are different phases of both the market and the economic cycle. Where are we in this cycle, and what does that mean for the next couple of years?
Yeah, I mean, so this is one area where I'm going to say this time it is different. I'm going to say those dreaded words because I think that, where we are today is not necessarily as clear cut in terms of late cycle, early cycle, recession, no recession. I think I think we've had areas of strength and areas of weakness over the last few years. I mean, we had a global pandemic, a complete shutdown of global economic activity. And then you had certain pockets of the economy become oversubscribed and other parts of the economy become undersubscribed. And there's been that shakeout ever since. So I still think we're in this environment where goods versus services, we're working out that demand. We've seen inventory tightness and inventory laxity. So we've seen a lot of kind of cross currents that would problematize just calling this a normal Fed hiking cycle. I do think that the other factor that has shifted demonstrably and deserves more airtime is the idea that, if you look at the areas of risk today across the spectrum, corporates and consumers were just given a bunch of money from the Fed and the government. The areas of risk and indebtedness are sitting in on the government balance sheet,
right? Not
necessarily on corporate or consumer balance sheets.
Right. So everybody refinanced except Uncle Sam.
Exactly. Uncle Sam took took the whole pile of it, and it's sitting right there on our balance sheet.
And I recall seeing a number of senators and congressmen, and they should chisel this on their tombstones. If we refinance at lower rates, it'll just encourage more spending. It's like, no, they're going to spend more no matter what the rates are. You might as well get a better rate.
Exactly.
It was just one of those like dumb things that politicians say that as soon as you hear it, it's not true. And now we're stuck with a lot of debt, and we didn't even get a benefit of a decade of low rates.
Right. I mean, I think this debt sitting on government balance sheets is something to worry about. I mean, I think the other aspect to worry about is not publicly traded equities, which are marked to market on every change in every macro number.
Tick by tick.
Tick by tick on a millisecond basis. But if you look at private credit, private equity, commercial real estate, we already know it's problematic. Residential real estate, we haven't seen a lot of turnover in residential real estate because nobody wants to walk away from their mortgages.
Yeah.
So I think those are the areas where we should be more worried. But if you're looking at a stock, it's pricing in the current environment of rates, inflation, like kind of everything that's going on right now is in a publicly traded equity vehicle.
Not too long ago, we were having a conversation about, so everything going on in the college campuses now. We were talking about the various endowments and how they performed. And somehow in 2022, when stocks were down about 20% and bonds were down about 15%, these endowments, some of which are 20, 30, 40% alternatives like private equity and private credit, they did just fine.
Yeah.
It's great when you get to mark to make believe.
Yes.
You could just put what should we mark this? I don't know. What do you want it to be?
Right.
All right, let's put it flat for the year. Flat in this environment looks great. I wish I could get away with that. I actually have to report real performance, not made up stuff.
Exactly.
And I've heard consultants pitch it, in a down year, you have like 2 years to change your mark on that. And by the time you change your mark, it's probably recovered.
Yeah. I mean, I think this is an area that could be ripe for regulation. I just don't know how the regulators will figure out how to regulate it. And I'm sure that will create this sort of whack-a-mole type of environment.
Well, if you remember back during the financial crisis when everybody had to mark to market, even things held to maturity that were underwater, they had to mark to market, and that was one of the changes that came about. Okay, if this doesn't have any payments due and it's in your hold to maturity account, you don't have to market, which allows a lot of junk to kind of get swept under the rug.
Absolutely.
And that becomes a feature, not a bug.
And here's the really worrisome thing. So if you think about just private equity, the amount of capital raised since 2017 is basically, it doubled the size of the private equity market. Think about how we were geared in 2017, 2018, 19, 20. We weren't thinking about 5% interest rates.
Right.
It was
we were at
lower
zero.
for longer.
Right.
Inflation's going to stay low. Disinflationary pressures, disruption, blah, blah, blah. That was the mantra during that entire stretch of time where a ton of money was raised in these long duration growth themes that were priced for an environment of zero rates forever.
Right, you're getting nothing on bonds, but hey, look, I can get you 5 or 6% in private equity. The only rub is it's locked up for 7 years.
Exactly.
So once you had the pandemic, which changed everything, you had the biggest fiscal stimulus since World War II in the first CARES Act, to say nothing of CARES Act 2, those two under President Trump, and CARES Act 3 under President Biden. The fiscal, you mentioned regime change earlier.
Yep.
The previous regime was all monetary in the 2010s. In the 2020s, it's mostly fiscal.
It's fiscal, it's inflationary, it's protectionist. I mean, everything going on right now, deglobalization and fiscal stimulus, these are inflationary trends. So I think that the idea that inflation and rates are going to remain low is, it's problematic. And, even this year, look what happened. The Fed was supposed to cut, 4 times? That's
we were also supposed to get a recession. And
I know, all sorts of things
so all these things, right? And none of them happened. That is your sell-side indicator in action.
Exactly.
All the consensus things, a recession in 22, a recession in 23,
wrong.
the Fed will start cutting in 23. No, we're going to push it out to 24. None of that has proven to be true.
Yeah. I mean, I think that where we are today is actually a reasonably healthy point for equities. But the areas that I worry about are that bottomless pit of, unmarked assets that have doubled or quadrupled in size in asset allocation. I mean, think about the average teacher or firefighter's pension plan. It's 30% illiquid today versus 5%, back in the 2000s. So, stuff has changed, and that's where I worry. But I don't worry as much about, big cap companies that everybody is tracking and watching and monitoring.
So I want to get to my favorite questions that we ask all of our guests. But before I do that, I just have to throw a curveball at you. So you had mentioned your predecessor, Rich Bernstein, who had bid with Merrill for a long time before he went out and launched Rich Bernstein Associates, Rich Bernstein Advisors?
Advisors.
RBA, right.
Yes.
When he left Merrill, he was roasted, and you famously read about 10 bullet points.
10 things I've learned from Rich in my 10 years working for him.
They were hilarious. Perhaps my favorite, a midlife crisis on Wall Street doesn't have to involve a Ferrari and hair plugs. A Mini Cooper and a leather rubber metal man bracelet will do just fine. Tell us a little bit about your Rich's exit roast.
Oh, goodness. It was terrible because I went first and I said 10 really mean things about Rich. And then everybody that did the speech after me said really nice things about him.
But that's what a roast is supposed to be.
I was like, this is not a good roast. You guys need to get into the trenches and say some mean things. But I was the really mean one and everybody else was really nice.
So if they were going to do a roast of you, what would the worst thing they say about you on the way out be?
Gosh, there's so many things they could say.
Well, what's the nice thing they would say about you?
I mean,
let me rephrase that. What would you be most proud of someone saying about you?
Well, that's a good question. I think I would be happy if somebody said about me that I helped them in their career. I mean, I think that's what we're all here for. But I think the terrible things that people could say about me were that I, chronically forget my ID. Like 4 out of 5 days a week, I don't bring my ID to the office, and I have to get the security guard to look me up in the system.
They're so fastidious. This is absolutely true story.
Mm-hmm.
One day, sometimes I take this off when we're recording. On the other side of that studio is where Mike sits, some guy named Mike Bloomberg. And he must have taken his off and gone up to get coffee or something up there. And on the way back, the guard says, "Sir, I can't let you down without a tag." And to his credit, and this is a good display of leadership, turned around, went down to the basement, got a temporary,
Good for him.
came back, and everybody saw it. If Mike did it, well, then how could we not do it?
That's right. That's right.
That's pretty hilarious.
Good for
So
Mike.
what happens when you show up without your badge?
Well, the sad thing is that all the security guards
They know
now
you at this
know
point.
me because I've been there.
But don't
so
you have to
many
swipe
times.
in?
Well, they give me a temporary ID, and then I go upstairs. But yeah, there are a lot of things that I could be roasted on. I always walk the wrong direction out of a door. I always go the opposite direction of where I'm supposed to be going.
No, you don't have a good internal
I have
gyroscope?
no good. Yeah, my compass is completely destroyed. But there's a lot of raw material to roast me on. I mean, it would be.
Well,
I
hope I get invited to that. That sounds like that'll be fun. So let's jump to our favorite questions that we ask all our guests. Starting with, what have you been streaming these days? What are you watching?
Oh, well, I just
watching, listening to, whatever.
I just finished watching The Gilded Age, which I thought was really fascinating. It's
The Gilded Age.
It's on HBO Max, and it's about like old New York, like basically, the Upper East Side in the railroad baron era.
Was that really the Gilded Era?
I suppose that's what they call it. I mean, it seemed pretty interesting. It was kind of fun if you live in New York to watch that. I rewatched Breaking Bad because that's
We were
my
just talking about.
favorite.
I saw the first
show
season
of all
and kind of
time.
tapped out afterwards.
I know. No, I mean, I hate to say this, but I really feel like you need to give it another season.
I mean, during the pandemic, we were, you're stuck at home. We went through a bunch of things, like Mad Men. I had never watched a single episode of that.
Oh, yeah.
when that was on TV, and we blew right through it.
Mm-hmm.
So the competition for things that were like, when someone says, you got to give it a couple of seasons, I'm like, it turns out I don't have to. But I understand.
You don't.
I
You'll
understand
make
the
more.
point.
Yeah.
We talked about Game of Thrones.
Yeah.
Are you a fan?
No, couldn't
So,
get into it.
I watched the first, and I know a million people who say it's the greatest show.
Yes.
You're a sci-fi fantasy guy. You should love it. Like, first of all, I can't keep up with all the names. My brain is oatmeal.
Takes too much
Right? It's like,
mental
wait,
energy.
I need a notepad. Like, this is who of Visigoth of what? I'm.
Yes, I think I fell asleep like 3 times trying to watch the first episode.
The first
not a good sign.
couple of episodes are very slow.
Yeah.
And then the other, so the first season of White Lotus was great.
Oh yeah, I loved White Lotus.
But we're watching the second season, and everybody is just they're not Succession bad, which is another show that
Right, that's next
everybody
level
says is
bad,
great, and
yeah.
why do I want to spend my time with these people? But, like, I want to be entertained and come away with, like,
a
that was
positive
fun.
feeling.
Right.
Yes,
Not
yes.
like, wow, those people are jerks. Thank goodness I don't work with anyone like them. It's just like, so what else? So if you watched The Gilded Age,
Yes.
did you see The Crown?
Oh, I loved The Crown.
Love The Crown.
Love The
So
Crown.
every episode was a joy.
Yeah, that
Just
was fun to
visually a feast for the. It was.
watch. And my
just
12-year-old
spectacular.
son watched that, with me,
Really?
which was kind of cool because I didn't realize he
What
was.
was?
A huge,
Well, how did he find it?
I don't know. He just wandered into the room while I was watching it, and then he sat down, and then all
Got
of a
sucked
sudden
in.
he was engrossed, and we're watching this series together about the Queen of England.
It was really
Kind of
fascinating.
random.
It was. I know it's sort of semi-fictional, but
Yeah.
I found myself asking questions and Googling things.
Oh, me
and
too.
Did that happen? Really, it was
Yeah.
amazing. Give me one other thing you're watching that you thought was fun.
Okay, let's see. Breaking Bad, The Crown. Gosh, I'm coming up blank.
The problem with Breaking Bad, there was a show, I don't remember what I watched, called Fauda, about Israeli counterintelligence agents that are infiltrating various terrorist groups. And it's so stressful that if you watch this show after 8 o'clock at night, you're not going to sleep till midnight. And like you, I'm an early riser.
Oh, right.
I can't be on the edge of my seat wondering who's gonna be found out and
Oh my
murdered
gosh.
by the.
Okay, I just remembered a show that gave me PTSD. 24. Have you ever watched that?
Oh sure.
Oh my goodness.
It's
I watched
with
that
the
with my
clock ticking
husband.
down the whole time.
Ah, it was but I binge watched that because you can't not watch an entire season if your calendar allows.
Once you get into one episode, you're just gonna.
But it was
plow up.
so stressful. I think that might have taken years off of my life.
We just finished The Gentleman, which is also kind of stressful. So I always save some comedy show as sort of like a palate cleanser.
Yes.
Now
yes.
it's Brooklyn Nine-Nine, but before that, it
Ted
was
Lasso?
Oh God, fantastic!
Yeah, very
Ted
good.
Lasso was like regular. The other show we've been watching on HBO that we loved is Hacks. Season 3 just dropped, and
I have to
it's
write this down.
so great.
Yeah. Okay.
So it's a woman comedian in Vegas who is slightly past her sell-by date, and her pushback against the men that run the casinos and the writer who wants her to become younger and hipper in her material, kind of a tell-all thing, and it's just really fascinating.
I love that.
Look at that.
Okay, that's on my list.
So season 1 and 2 were both great. It's not quite as cringy as Curb, but there are moments where you're like, don't do that, don't do that. Oh, you just see it coming, and it's just, don't tweet that. That's just gonna bite
Right.
you in the behind. Don't. But you get sucked into it, and you're rooting for the character. So that's a perfect example of fascinating characters who
Yeah.
are flawed but likable.
But
like you
lovable.
want them, you
Exactly.
want them
You're
to
rooting
succeed.
for them.
Right.
Exactly.
So maybe I'm too old school Hollywood, but I don't really want to watch people who I can't
That you
stand.
hate. I know.
Right.
I know. Who needs that? Who
Right,
needs that? We work
exactly.
on Wall Street. You don't need to go home to people that are jerks.
That's right. To have someone say something that, like, I think I have to slap that guy. You mentioned Rich Bernstein. Tell us about your mentors who helped guide your career.
Oh, Rich is definitely like just one of the key people that, really made me who I am today. I mean, I have to say my mother is like really who I imprinted on.
The software coder.
My mom was a coder. Yep. She came here from India when she was just 20 years old. She had an arranged marriage. They're now divorced. One of the worst arranged marriages of all time. But she was, she had a lot of guts. She wore a sari to work every day,
Really?
but somehow ascended the corporate ladder at Digital Equipment Corporation and became a manager. Even though people were like, you need to stop wearing the sari, she kept wearing it. She was true to herself. So I kind of look at her as a role model of how to just get stuff done, fade the haters and, do something good for the world, create some value.
Huh. Really, really interesting. Let's talk about books. I mentioned Adam Smith's Money Game. What are some of your favorites? What are you reading right now?
Oh, right now I'm actually I'm rereading an Agatha Christie novel that I love.
Which one?
The Murder on the Orient Express.
Oh, sure.
I know. I'm obsessed with Agatha Christie.
There's been, I think, 3 or 4
movies?
film versions. I don't mean like subsequent.
Yeah, but they're all terrible. Have you seen them?
So
I did not love
the
them.
early ones are kind of talky and slow, but they're kind of interesting character studies and.
Oh yeah. Well,
that's
they're
They're
Agatha.
truer to the book than it's not supposed to be a James Bond novel,
Right.
But some of them try and turn them into almost
action.
yeah,
Suspense. Yeah. My favorite book of all time is a book called Confederacy of Dunces.
Sure.
Did you read that?
Long time ago.
I love that book. I reread
the
that
author
every now and
is
John Kennedy O'Toole.
Uh-huh.
And it's
Then I
just
did
a
not read it. I'm
hilarious
thinking of a
book.
different book.
Okay, so I'll get you a copy. It's a good one.
Hold on.
I'm also reading this book by Peter Attia on how to live well, not necessarily long, but how to remain healthy and thriving. I find that health is becoming a bigger part of my concern set these days as I get older. I mean, I turned 50 a year ago and I'm starting to think about, I want to see my grandkids. So how do I keep this thing going and be happy and healthy?
It's not just about longevity, but of quality of life.
Exactly.
As we
And
age.
that's what Peter Attia is really focused on. So I thought that was an interesting one. But yeah, there's so many things to read. I don't read a lot of nonfiction
Oh, really?
I don't read a lot that has to do with financial markets.
As I've gotten older, I find myself reading more and more nonfiction.
Really?
And when I was younger,
Interesting.
a big sci-fi fan.
Me
just
too.
like a
like
ton
Philip
of.
Dick, that was my favorite.
So my
Love Philip Dick.
people don't realize Minority Report, Blade Runner.
Blade Runner, I know.
Total Recall. These are all, and then the I think it was the Amazon series, that takes place when it's an alternative history where Japan and Germany win World War II.
There's an Amazon series.
That's an Amazon series based on a Philip K. Dick book, which of course escapes my recollection
I don't
right
think
now.
I read that one. Yeah.
Man in the High Tower was the Philip K.
yeah.
Dick book, right? And
I
that
did
became an
read that.
Amazon series. I can't believe I pulled that title out of
that
my...
was really good. I kind of forgot it. The nice thing about getting older is that you can reread books.
And it's fresh.
And it's like the first time you read it.
Three Stigmata of Palmer Eldridge, Ubik. Like, I remember those books as being
Ubik. That's
super dense and super, heady.
Yeah.
And rereading them now, it's like, oh, okay, I have a different context
Yes,
to see these.
I know.
What sort of advice would you give a recent college grad interested in a career in either finance, quantitative analysis, or investing?
Well, I mean, the first piece of advice isn't specific to finance, but it's just, don't be a jerk.
Okay.
I think there are so many people out there who are trying to prove that they know more than the next guy that, they stop listening. They're just like, trying to seem smart. And I think that's your number one enemy in
What drives that? Is that a modern thing with social media, or is that always throughout your career been an issue?
It's just like insecure people that needs to prove themselves. And what I found is, if the way you treat people that are working for you says a lot about you. Huh. And the problem is, if you're mean to the people that work for you, someday they might become your boss. So I think that's another piece of advice I would give.
This has nothing to do with you being an intern at the Merrill Quant shop and eventually leading that shop.
No. I've not personally experienced that too many times in my life, but I've heard about it many times. And I think that's just bad practice. When it comes to finance and investing, I think the idea of being flexible in thought, always checking your own biases. I mean, this is where the philosophy comes in. So Friedrich Nietzsche has this theory of constantly overcoming, and that's the idea that you should always critically examine your assumptions and make sure that you're not making a mistake.
Life is struggle.
Yes. I mean, life is struggle. That's also a Nietzschean quote.
Right.
But I think the idea of just always kind of checking yourself and seeing whether you're assuming things that aren't necessarily true.
And our final question, what do you know about the world of investing today you wish you knew when you were getting started in the early 2000s?
Look, I wish I'd started investing earlier. I was always too risk averse. And then once I started to get some cojones, I was, 10 years into my career. I wish I'd just socked away more money in, kind of the riskiest, most volatile asset classes, because that's where, when you're young, you can really take a punt.
You can afford the risk, and if you have a setback, so what? You can overcome it.
There's time, and volatility gets easier with time. I think the other kind of metric that I wish I'd known about is, and this is specific to the S&P 500, but the interesting thing is, if you own the S&P for a day, you have about a 50-50 chance of making money or losing money. But
meaning the next day.
The next day. So your probability of making money by buying and selling the S&P over a one-day period is about a coin flip, a little bit better than a coin flip. But if you have a buy and hold over a 10-year period, your probability of losing money is de minimis. It's like less than 5%. So that's the idea of just extending your holding period, set it and forget it. I think those are some of the tricks that I try to impress upon individual investors is, the day that you want to sell because the market just went down a lot is probably the worst day to sell, because the best days for the S&P typically follow the worst days.
They cluster together.
So it's just, get rid of emotion when it comes to investing.
Savita, thank you for being so generous with your time. This was really fascinating. We have been speaking with Savita Subramanian. She is the head of U.S. Equity and Quantitative Strategy for Bank of America. If you enjoy this conversation, check out any of the 500 we've had over the past 10 years. You can find those at iTunes, Spotify, YouTube, wherever you find your favorite podcast. Speaking of podcasts, check out my new podcast, At the Money, short conversations with experts about your money, earning it, spending it, and most of all, investing it. Find that wherever you find your favorite podcasts or here in the Masters in Business feed. I would be remiss if I did not thank the crack staff that helps put these conversations together each week. Sarah Livesey is my audio engineer. Atiko Valbrun is my project manager. Anna Luke is my producer. Sage Bauman is the head of podcasts here at Bloomberg. Sean Russo is my head of research. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.